All right, welcome to The Explainer. Today, we're going to talk about the single most popular metric for valuing stocks and why it might be totally leading you down the wrong path.
Look, let's just get right to it. The price-to-earnings ratio, the PE ratio, the one metric that millions of investors look at first, it has some serious, hidden flaws that can cause you to make some really bad calls.
So, okay, what is this famous PE ratio anyway? And why is everybody so obsessed with it in the first place? Let's break it down.
Okay, so here's the deal. The PE ratio basically tells you how much you, the investor, are willing to shell out for every single dollar a company makes. So a PE of 10 means you're paying $10 for $1 of profit. Theoretically, it would take 10 years to earn your money back. It's simple, it's easy to find, and honestly, that's why it's everywhere.
But here's where it gets a little tricky. There isn't just one PE ratio. You've got the trailing PE, which looks at what the company actually earned over the last year. It's real data, but it's all in the past. Then you have the forward PE, which is a guess, an estimate of what analysts think the company will earn. It's forward-looking, sure, but it can be way off.
And this, right here, is the core of the issue. A low PE might scream cheap, but what does it really tell you? Nothing about growth. Nothing about debt. It doesn't even tell you if those earnings are actual cash. You know, relying on PE alone? It's kind of like trying to drive a car by only looking in the rearview mirror. You're going to miss the huge truck right in front of you.
Okay, so let's tackle that first flaw head-on, because it's a big one. The PE ratio completely, totally ignores a company's future growth. So, let me ask you this. Is a company with a PE of 15 always a better buy than one with a PE of 30? I mean, your gut says yes, right? Cheaper is better. But what if I told you the company with the PE of 30 is growing 5 times faster? Huh. Suddenly it's not so simple, is it?
And that's the whole point. Without knowing the growth rate, you're just comparing apples and oranges. Look at company A here. Sure, it seems cheap, but its growth is, well, it's kind of sleepy. Company B, on the other hand, looks pricey, but its earnings are just taking off like a rocket. You're paying a premium, yeah, but you're paying for that insane growth.
And that brings us to our first real upgrade, the PEG ratio. This little metric is brilliant because it solves this exact problem. It takes that PE number and puts it into context by factoring in growth. It asks a way smarter question. Am I actually paying a fair price for this company's growth?
And what's cool is it gives you a really simple rule of thumb. If the PEG ratio is around 1, things are looking pretty fairly valued. If it's under 1, you might have found a bargain. But if it's way over 1, like this 1.67 you see here, well, that's a warning sign that you might be overpaying for the height.
All right, so we fixed the growth problem. We're feeling pretty good. But what about the E in PE, the earnings? Well, this is where things can get really murky.
You don't have to take my word for it. Just listen to this user from the CFA subreddit. They hit the nail on the head. Earnings aren't cash. They're an accounting number, and they are full of judgments and adjustments. They can be played with.
So what we really need is a metric that cuts through all that accounting noise and gets closer to the real cash a business is generating. And, super important, it needs to account for debt, which PE completely ignores. So, let me introduce you to the EV to EBITDA ratio. Yeah, it's a mouthful, I know, but trust me, it's a beast.
So here's the difference, and it's a game changer. The P in PE is just the stock price, the market cap. But the EV, enterprise value, that's the price to buy the entire company, debt and all. It's the true price tag. And while earnings can be full of accounting tricks, EBITDA is much closer to a company's raw operational cash flow before all the financial engineering kicks in.
Okay, we're definitely getting a much clearer picture now. But there's one more huge problem we have to talk about. A company's earnings in a single year can be a total fluke. I mean, think about it. In a booming economy, everyone looks like a genius. In a recession, not so much.
And to fix this problem, a Nobel Prize winner named Robert Shiller came up with something called the CAP ratio. The idea is pure genius. Instead of looking at just 1 year of earnings, which can be all over the place, it looks at the average earnings over the last 10 years, adjusted for inflation. It smooths out all those crazy peaks and valleys from the business cycle.
And you know what? Historically, this thing has been an incredible warning sign. It's like a smoke alarm for the entire market. It was screaming danger right before the huge crashes in 1929, 2000, and 2008. When this number gets really high, it's basically telling us that stocks as a whole are getting way, way too expensive.
So after all that, which is the best ratio? The PE,
The PEG, EV/EBITDA, CAPE? Well, here's the secret. It's a trick question. The answer is none of them, at least not by themselves. The goal isn't to find one magic number. It's to build a complete valuation toolkit.
And maybe the most important tool in that entire kit is just understanding context. I mean, what's a good PE ratio? The answer is it's meaningless without knowing what industry you're looking at.
Yeah, just look at this. It says it all. An auto company might have a PE of, say, 8. A software company could be at 40. So is a PE of 20 good or bad? Well, for the car company, it's ridiculously expensive. For the software company, it might be the deal of a lifetime. See? Context is literally everything.
So here's how you put it all together. You start with the PE ratio, but only to compare a company against its direct competitors. Step 1. Then you bring in the PEG to ask, okay, but am I paying a fair price for its growth? Step 2. Next, you dig deeper with EV/EBITDA to check the actual health of the business and its debt. Step 3. And finally, you zoom out with the CAPE ratio to see where we might be in the bigger market cycle. You're building a 3D picture, not just looking at a flat photo.
So now you've got a framework, a real toolkit to make much smarter, more informed decisions. But it does leave us with one last big question. Even with all the best tools, you're still trying to predict the future. And how certain can anyone really be about that?